You have saved money. Well done. You're doing better than most people on the planet. Now you're feeling a bit lost and quite anxious about how you can take that money and make it prosper. You're not alone. This is one of the key stresses that people have when it comes to managing money. And particularly because I'm sure that your friends, family, neighbors, they all have plenty of good advice to give you with regards to what to do with your money. But there is only one person that must deal with the consequences of your choice in terms of how to invest your money. It's you and your family. In this video, we will go through two investment strategies, the active investing and passive investing. We will define what they are, and also we'll look at whether or not they can help you to build the wealth that corresponds to the goals in your life. If you stay tuned, I will then tell you about an alternative to those two investing strategies. Let's get into it. My name is Greg Gilbert. I'm a life and personal finance coach. I share what I know on a cup of coffee about personal finance and coaching to help you live a life of purpose and building up your wealth. What is passive investing? Passive investing broadly refers to a buy and hold portfolio strategy for long-term investment horizons with minimal trading in the market. Index investing is probably the most known passive investing strategy that there is out there. This is when you're following a main index worldwide like the S&P 500 and you hold for long term. We have to thank John Bogle in the 1970s for creating the concept of index trackers, basically, which later became ETFs, and that are tracking main indices on the planet. This links to the efficient market hypothesis from Eugene Fama. It states that all information relative to a stock is already priced, therefore your focus should be on finding value, not speculate on potential information mismatch that would influence a stock. That means a stock market with rational actors, i.e. people who are not dealing with emotions when they're trading. Does that sound like humanity? Some of the benefits of passive investing are low fees. That is if you invest through index ETFs. If you do buy and hold by yourself, then you pay the brokerage fees linked to your broker when doing the transaction and then nothing else. It's tax efficient. You have less tax when you have a long-term strategy, as you do not usually suffer from short-term capital gain tax. And there is simplicity in your choice. That is, if you decide to follow broad market indices. Some of the potential drawbacks are, it can be a bit limited as indexes do not cover every type of market segmentation that you could think of. So the choice has increased enormously over the last decade. Your returns will follow strictly what the market does for the index you picked. So you go up and down and have to live through it emotionally without thinking that you have any control. You effectively buy a lot of duds. It means a large part of indexes is made of companies not performing well and a minority of super performers. There is a contradiction in terms with passive investing. On paper, it means you have less choice and therefore it is easy to decide. Though that is only valid if you pick some very broad indexes like the S&P 500 or the total worldwide market or the total bond market worldwide. A buy and hold strategy is not only valid for indexes, it's also valid for stocks. So if you have a high conviction in a stock, you can basically buy and hold it for very long term. And if you do that, it means that there is an awful lot of choice worldwide in terms of which companies you can acquire a high conviction that they will do well long term. Hence the contradiction about choices. What is active investing? Active investing refers to investment strategies that involves ongoing buying and selling activity by the investor. Active investors purchase investments and continuously monitor their activity to exploit profitable conditions. Here the hypothesis is that all the information about a stock is not integrated in the stock price at all times. That means that there are other factors, news, maybe the weather, who knows, emotions of investors which are impacting the stock price, effectively meaning an inefficient market with irrational actors living with and investing with their emotions. Now, does that sound like humanity? Some of the benefits of active investing are risk management. If you have good foresight, you can get out of short-term bad situations for stock sectors. Like in 2008, you would have got out of the banking sector before it crumbled. You can use short-term trading strategies like swing trading, where you estimate short-term movements of stocks and take advantage of that. Some of the potential drawbacks of active investing are frequent trading is costly, as you have to pay commission fees, whether directly if you buy and sell stocks or through high management fees for managed mutual funds. You need to be very knowledgeable of how the market swings work and have the right tools to analyze that. Even with that, it remains an arcane exercise. A contradiction in active investing is the fact that you're supposed to be buying and selling very frequently. So people assimilate active investing with also being in managed mutual funds or having a financial advisor who is basically doing the buying and selling of the stocks for you. But if you do that, you effectively relinquish the choice, which is fundamental part of active investing. Does this video resonate with you so far? So you know what to do, and do not forget to subscribe to the channel and put the notifications on if you want to receive more content like this every week. And do not forget to check out in the description, there are other YouTubers, YouTube videos on the same topic of active and passive investing. Check it out to learn more about the concept. Passive versus active performance. Typically what you will see for comparisons for passive investing versus active investing is on one side we're looking at index ETFs, and on the other side we will be looking at managed mutual funds. If you stick to this narrow definition, then you will see here that managed funds, active funds, fare really poorly compared to index funds, passive in all equity funds categories. You can see that they're well below the 100% that they should be, or more than 100%. The problem of just looking at managed funds on one side and index funds on the other side is that it's actually a contradiction with the definition of active and passive investing. Under passive investing, you can also consider stocks for which you have a long conviction and keep long term, and also index ETFs, which are based on much narrower markets like small cap, large cap, etc., or group of companies like biotech, technology. And under active investing, you can also consider all the trades that individual investors make short term, you and I, anybody who is actually having a brokerage account and doing their own trades. You can also consider the hedge funds, private equity, if it falls into the frequent trading part. If you take all of that together, it's almost impossible to be able to really compare active versus passive investing, because not all of those categories are being monitored very closely. Choice investing. Passive and active investing are misnomers. As I raised for each one of them, the point is not really about whether you are active or passive, particularly if you make a comparison between managed funds and index funds. In a way, it would be more accurate to actually call that long-term investing versus short-term investing. Passive investing here becomes a long-term focus on the value of companies. Active investing focuses on arbitration of short-term discrepancies on stock prices. Where they get mixed up is with regards to the concept of choice. It sounds like passive investing is about having less choice than active investing, but that's not true. You can have as much choice as you want in passive investing as in active investing. The main difference is the goals that you have behind the strategy. And that is what matters. What is the goals that you have for your investment? In this video here and here, I review the different goals that you can have when you're considering investing your money. This is what matters when you decide where you want to invest your money. Another key element is time. Whichever choice you make, that choice very much depends on the quantity and quality of the information that you have about the choice that you intend to make. The more time you have, the more time you can do your own research, the more time you can accumulate information that allow you to make more judicious choices with regards to what you invest in. And if you have no time to do some research, then trying to beat the market in that situation is extremely difficult. So if you have no time, well, you can whether find somebody who is going to do the investment for you, an investment advisor. My personal experience with that is it's not been great. I'm at my number 4. Or you can invest in very broad indexes like worldwide stock market or worldwide bond market, where effectively what you're saying is that you do not want to have a choice. You basically accept that you will go with wherever the world is going, and that you will be totally comfortable with not making a choice at all. Something key to remember here is that we are only talking about investing in stocks and bonds. You can apply this concept of spectrum of choice, whether you have no choice to having plenty of choice, to any other type of assets like gold, crypto, real estate, art, etc. By now you've probably understood that I don't believe that passive and active investment make a lot of sense as investment strategies the way that they are commonly talked about. And the main reason is that I think they're very poorly defined, and also they do not take into account some key aspects of the goals that you have, the choices that you want to make, and the time that you have to actually accept the drawbacks that you have with making the right choices. If you want to explore further the concept of choice, check out the video last week here and here that will help you to understand what is the spectrum of choice. I hope you have found this exploration of different investing strategies interesting, and I will see you next week to talk more about personal finance and coaching on a cup of coffee.